Hey everybody, Bill Faeth here from Build Short-Term Rental Wealth. Welcome and happy Father's Day to all the fathers out there. Hope you guys are having a great Sunday. I love this day, not because it's Father's Day. Well, I mean, that's part of it. If you got my email this morning, I didn't grow up with a father, so I don't really, care about that because I won't get into that. But I love my daughters. They gave me a really nice gift this morning, something very meaningful. And just very appreciative for you, the mothers out there that are playing dual roles as mothers and fathers. I had a great mom that, was my mom and my father. So anyways, also love it because it's US Open Sunday at one of my favorite places, Los Angeles Country Club in the heart of LA. And so I'll be watching that a little bit later. But today I want to talk about how I build super portfolios. And it really takes a lot of effort, a lot of knowledge, a lot of experience to be able to build a super portfolio. But most importantly, today's going to be about identifying our return on equity and then really leveling up our portfolios. So unless you're independently wealthy, most of you did not start by buying $1 million properties or $1.5 million properties. You probably started like I did, buying much smaller properties. I mean, the first property I bought was $109,000 27 years ago. And then as I got into the STR space, I spent like 124,000. It was 123, 124,000 bucks, which I saved up for my very first property, and I built my entire portfolio out of cash flow. So I'm going to show you a few things. I've got a second screen over here on how I keep track of my equity positions, of how I keep track. It's this very simple spreadsheet. I like to keep things, dumbed down and very simple to be able to follow. This is one of the few times that I jump onto my setup here. I've got, two iMacs and another monitor over here. So you'll see me looking left and right. Most importantly, thank you for being here. And I just love this to be interactive. So ask questions, at least say hello. Let me know where you're from. Where are you at watching this? Today I'm at my home office in Nashville, Tennessee, spending the day with my family. And I see Sheila. Hey, Sheila from Washington. Just let me know where you're at. And if you have any questions as we go through this, this is going to answer a few questions for you guys if you know why I sold my Beach Mountain property. And then I've put another one, actually under contract twice, 2 properties right now, and actually looking for a third because I'm leveling up my property. So I'm not the guy, if you're new to following me, I'm not the guy that's looking for 50 or 100 units. I don't want any part of that because the time equity, as much as the financial equity, is just as important to me. Might be a little bit different if I was 23 or 24 years old. Again, just getting started, I would probably be looking to acquire more. But for me, I built all of my businesses based on less is more, meaning I want high profit margin and less time invested. And I've really been intentional with that since about 2015. Hey, Melissa from Houston. Jillian, thank you very much. I appreciate it. Watching from the side of our neighborhood pool. I love it. Stacy, Eric, and Casey at our OBX property, currently building a new deck. Awesome. Happy Father's Day. Thank you so much. Same to all of you out there as well. So let me get rid of this. And I'm just going to turn over to a spreadsheet and share this with you here. Why is it not? Shit, I might have disconnected it. So let's just connect again. There we go. And I'm going to show you this. So one of the things that I'm a big proponent of is keeping P&Ls, running my P&Ls to get them done by the 5th of every month. I want to have this intimate relationship with my financials. If you're not doing that now, this might be a little bit more challenging for you to get started with, but this is a really simple spreadsheet. I do this in Google Sheets. You can see that I've got a line here. This is for 2022. And I'll explain this in a second. So this was 2022. This is the property. You can see they're all listed down here on the left-hand side. And then I have my debt. This is what I owe. This is what my payoff would be if I was to sell these individual properties. This is the current market value. So you can see my debt is 5.3 million. Current market value is about 13.3 million. Gives me equity of just under, we'll just call it $9 million in equity. It's generating, the portfolio is $2 million in revenue. Net's about 977. Then I'm really coming all the way over here to column H and looking at what the year to date is. Now, what you have to keep in mind is where are your properties. So if your properties are just getting into peak season in June and we're halfway through the first month and peak really started in May or really around Memorial Day, and you've still got half of June, you've got all of July, you have August leading into Labor Day, then you need to adjust these numbers accordingly. So none of these numbers, essentially, if I look at my revenue, have hit the 50% mark because we're just coming into summertime. And even if you're in ski markets, it might be a little bit different if you're in the Beach Mountain area or the snowshoe area, but if you're in the Mammoths or Yellowstones or Whitefishes or Big Skies or whatever, you're still going to have really solid summer. So you need to factor that into the equation. So I will actually go and look at a little bit deeper sometimes if I need to, and then maybe go back and do a first half report on a P&L, just run in and into QuickBooks and run, a 2020 January through June, and then compare where I was at in 2022 in this column here with where I'm at in 2023. But what I'm looking for right now, the first place that I'm going to go is I'm going to come over here to F, and I want to look at what is my lowest income. And then I'm going to assess, okay, I've got AZ1 66, I've got GS3 is 64, CA1 is 61, there's 59, 63, 27. So 27 stands out like an absolute, sore thumb to me. So I'm just going to go ahead and I'm going to highlight that in red. That is my lowest net income provider. Almost everybody in social media, all you guys talk about is revenue. I don't really give a shit about revenue. I care about how much money I'm actually making. What am I taking home? So I'm highlighting the 27,000. Then I'm just going to slide over here and go to the equity. Okay, I've got $193,000 in equity. This is my Beach Mountain property. This has actually already been sold. I just closed on this 2 weeks ago. So this is a real example of something that I've done. So $27,000, and let's just say that's 109. Let's round this down to 190 and raise that to 30,000. How many times does 30,000 go into 190? I'm not real smart, but that's about 6 times. So that means I'm going to have to manage this property for 6 years, netting $30,000 a year to get to $190,000. Well, fuck, that's a long time making a very little amount of money, barely over, $2,200-$2,300 a month. So I'm going to go ahead and sell this property. Now I need to understand what my exit is. This is the current value. That's actually what I sold the property for. This is my equity inside of the property. So, but I did do a DSCR product through the lender when they were a title sponsor for my conference. So I have a prepayment penalty on this that cost me $18,000 on a prepayment penalty. Let's just round it up to 20, once again, for easy math. So really, I'm only going to, about 175,000, really 174 is what I'm going to net. Now, once I know what I'm going to net in that property at $174,000, I have to be very, very honest with myself. Can I reinvest that $174,000 into a better investment and generate more net cash flow than this $28,000? There is absolutely no question in my mind that I can. With $193,000 less the 18, let me just change that for you right now. I'm just going to call it 174. With that 174, I know I can go in and buy a $750,000 property. No question. I mean, I can buy $1 million property. I'm probably gonna have to put, 25,000, maybe 30,000 into it to get it closed with, if I'm going to put 20% down, I usually budget about 3% in closing costs. So, but I know that I'm going to be able to generate more income than 27,000. Super duper important. A lot of you may be looking at this. This is my new Whitefish, Montana property. I have not started renting that yet. So that's why that is at 0. So now if I can invest that 174,000 and put that, and I'm under contract right now in a $1.2 million property in a new location that I have never invested into. But one of my super team members is invested there. I know 3 or 4 other hosts that are invested into that market. I've spent the better part of the last 6 weeks analyzing everything in that market. It's a large market with multiple, places to be able to invest, multiple sub markets. Identified that down to something that really isn't that existent. It was hard to get comps on, and that's a 7-bedroom, 5-bath in this market. They pretty much cap out at around 5 bedrooms. So that should do conservatively 285 to 300. And I'm pulling back the downturn. I'm not going off at 2022 numbers. Let's just call it 300. We really think with what we're going to do to it, we're going to put about 150,000 into it, that we can probably do closer to 325 to 335. Our operating expenses on this property should be around $145,000. So if I can do 300, not even scale up above that, minus 145,000, that's roughly 155,000 in net income. So then if I take the 3 here, the 30,000, and put that into 150, that is a 5-year return. What are you calling this spreadsheet? Quick balance sheet, something else? Mike, I didn't really call it anything. It's how I track my return on equity. So I just want to make sure that I keep all of this data here, so that way I can see my lowest net cash flow, and if I need to access equity, what I want to do here. So and you got to understand, this is why you need to have the overall plan of what you're trying to build within your portfolio. So I can look at these numbers, and I know that I'm basically trying to keep I've increased my debt a little bit, but I'm still in a really good debt position versus my current market value position. So if I had to exit today, the only other DSCR I have is on this property here. And I'm into year number 2, almost to year number 3 on that. So I'd owe about 2.5 years on a prepayment penalty. That'd probably cost me about $30,000. Everything else, this is really what I'm striving for, because I've got a life plan and I'm 50 years old and I'm retiring at 54, right? So trying to get my debt down as low as possible, but also optimizing. So I'm going to go back to the sheet again. I should probably just keep this up. What's interesting is you look at this number here. That's going to change once I get Whitefish online, which will probably be another 2 months, 3 months. And that's the thing that we have to look at when we're investing, right? So that property is costing me $7,000 a month right now. And I closed on it in February. So that's March, April, May, June. So as of right now, I'm $28,000 into that property. Negative. That's going to affect my cash on cash in my first 12 months. There's no question. I believe the septic tank they're drilling holes this week, which means they won't even start till the following week. It is going to be a 2-week process to get that in. Then it's usually another 3 to 5 weeks before I can get an inspector out to sign off on it. So now I'm pushing the end of July from right now. If things go according to plan, then I can apply for my STR permit, which is another 6 to 8 weeks. So I'm probably looking September, October, which will be February, March, April, May, June, July, August, September, 8 months conservatively, maybe 9 months. So it's $65,000 in carry costs that I have to eat. And I had to budget moving into this property. 100% fine with that, because this is really a lifestyle asset, and this property is going to do $200 a year when we're done. But what happened is, if you follow my plan, initially I wanted $800,000 in income. I've hit 977. The goal is to get to $1 million now. So, but I want to get to $1 million. If you notice, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 properties. That's 2 more than I want. It's 2 more than I want. So Beach Mountain is gone, right? So literally I can take Beach Mountain and I can just go Hydro. That's gone because I've already sold that property. So now I'm down to 11, and I have 2 under contract. So that means I'm going to go back and look at the properties and analyze them as I add the others, because I don't want to spend that much time hosting. So I've got to do one of 2 things. Either I've got to narrow down my portfolio to get back to that 10 number, because I don't want to have 50 or 100 units. Especially if I hit that $1 million mark in net income on an annualized basis. This is why I invest into large properties. This is why I call it the super portfolio, because most people are not generating this amount of cash off of 10 or 11 properties. Most people take 40, 50 properties to be able to get there. That's why this is so important. If you can take your equity and redeploy that and turn a $66,000 a year property, and if I wanted to grow and redeploy 600 grand, are you shitting me? I mean, I can easily buy $3 million worth of, well, probably $2.5 million worth of property at 20% down easily. So I'm not a 10% guy, because I want to make sure that I have plenty of delta down here. If that number was 9 or 10 million, I wouldn't be able to sleep at night. Since I've got 13.3 here and 5.3 here, basically a $9 million delta, I can sleep well at night and look at the cash flow. So one of the things I want you to do, just to recap, go off of your net income, not off the revenue. Understand that if you sell based on this equity number, you're going to have, this is just the equity. This does not withdraw. So you would have to subtract closing costs, realtor commissions, so I typically go in and I'm going to budget right around a full 10% just to be safe. So, that's going to reduce this by $61,000. It's going to reduce this by almost, $100 grand. So to be really realistic with these numbers before you go and start working on your pro forma to make your next purchase. But I can't emphasize enough, when you look at this number here, that's the only thing that matters from the financial perspective for me. But I also want to know how much time I'm having to invest to get to this number. Hopefully this makes complete sense. This all goes back to how I have built out kind of my life plan, my portfolio, that ties in why my wife and I go through this, and we have audits every Friday. Here's our Friday page. We haven't filled, this is a blank one. This is my last blank copy that I have, but you can see we go through and we audit our daily activities. We audit the week that we have, where we have a unified life plan that becomes super important for us, because we have goals that we want to get to. And the one thing that I'll kind of go back one more time, the goal, is to, this number in 4.5 years to be down to zero. So that's why I'm trying to add some more net income, because we don't live off of this. This all goes back to paying down debt for us. So if I can use that $600,000 that I keep in my investing account, and I can use this, and I deleted it, but the 193,000 to not have to tap into that 600 grand. And then if I can add another 40 to 55,000 in net income, that's going to get me closer to 1.1 million, which is going to get me inside of that 4.5 year mark to be able to pay this debt down to zero. But you got to remember, I'm going to be adding 20% down, adding roughly $1 million worth of debt, onto this. So those are the factors that I'm looking at as I level up my portfolio. I think way too many people are over leveraged today, that they have gone and they've done HELOCs to get access to this equity. It's one of the reasons that I sell smaller properties to level up. One, I don't like 8.5% interest rates for HELOCs and those types of things. Two, I'm trying to get my debt down. I'm not trying to leverage like I'm 25 years old. So that's where you got to take into account your age, your goals, your overall life plan, and be very, very specific. Hopefully this helps. If you guys have any questions, just drop a comment down below, or you can see right here, you can always send me a DM on Instagram at Bill Faeth. That's Faeth 73. Thank you for joining me on Superhost Sunday, everybody. Have a great weekend and happy Father's Day.